Ever wondered how your portfolio would hold up to the scrutiny of professional money managers? Well, one brave listener asked whether we would give his self-managed portfolio a careful on-air critique. So today, we give our unvarnished assessment of that portfolio and how the big life transitions facing this listener in the next few years influence our thinking. Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Erik Olson and Adrian Nicholson. Erik, welcome to another great episode.
Hey, glad to be here. Adrian, how you doing this morning?
I'm doing awesome. Glad to be here as well. It's always great when all three of us are together here on the podcast. I'm really looking forward to today's episode.
Yeah, we have a great episode for you today. We are nothing if not for the people. We've got a request from a recent listener and client of Erik's to review his overall portfolio. So we're going to go over that today. Adrian, why don't you fill everyone in on the background?
Yes, of course. So this person is an Illinois resident who's turning 65 in January. They have 2 adult children and are divorced, and this person's looking to retire in April 2023. This person currently has low expenses, they're pretty frugal, and they want to relocate when they retire and immediately do some upgrades to the place that they move in. Also, added on top of that, they're also looking to buy a new car as well. So this is all things that we're really going to have to consider with the background of this person. And also one major thing too to make note of, this person is also looking to do Roth conversions up to the 12% level through 2025 and then up to the 10% level in 2029. They're going to do the opposite of conventional wisdom. This means that they're going to be drawing from their Roth first, then their IRA, then their taxable accounts. So these are all the backgrounds on this person that we're going to be discussing today. And we're going to be looking at a portfolio and analyzing our thoughts and what maybe they could be doing better or some changes they can be doing to this portfolio. So guys, where do you want to start first with this?
So I'll just jump in with a few questions I have. Having just looked at the portfolio and not the overall financial plan, and we don't need to necessarily get to the answers today, Erik, if you may or may not have them, or it may just take us off course a little bit. But the first thing is, looking at the portfolio is I'd want to have a risk tolerance conversation. The portfolio is super aggressive, tech heavy. Is this the portfolio you built to get to retirement, or is this the portfolio you want to continue to have? My next question, and we called him Mr. Davis. So my next question for Mr. Davis then is the short-term goals of new car, getting all these home upgrades done. Is the cash sufficient for that goal? And with the home upgrades, it was a sale, buying, moving, and then buying another property and doing the upgrade. So if the cash is or isn't sufficient, is the home equity sufficient? What I'm getting towards with these questions are, is this portfolio needed for these shorter term goals, which changes the time frame and the investment plan? The next one, with them turning 65 and then retiring, where's the income going to come from now until full retirement age when Social Security kicks in, or age 70, assuming that the client is Social Security eligible. But once again, I want to get to the need of this portfolio to provide income and at what point, because that will impact the time horizon and the risk tolerance, which will then impact the holdings within the portfolio. So those are the financial planning questions I have. Now let's jump in to the portfolio itself. Gentlemen, did you have anything on the planning side or any thoughts on the questions that I had?
Yeah, I mean, I'll answer a few of those. So there's a considerable amount of true cash in the portfolio. Some of the portfolio at an aggregate level has about, let's just speak in round numbers here. Let's call it a $2 million portfolio, 15% of which is cash. So there's $300,000 of cash. And although some of that is embedded in the funds in the plan, but there's still a substantial amount of cash sufficient to finance those home improvements and also to round out the purchase of a home when the proceeds from the sale of the existing home are realized, as well as to undertake some of those upgrades. So that's not a big concern. That stuff, it shouldn't require selling in a down market or something to achieve all of that. But as to your previous question, one of your other questions was about Social Security. So yes, the plan here would be to wait on Social Security for another 5 years, and with that, then fund in the interim the lifestyle as much as possible out of existing holdings, so that there's plentiful opportunity to do ongoing Roth conversions until the Social Security kicks in, and even more so until the RMDs start kicking in at age 72. So Adrian referenced doing conversions through 2029. So we're looking at this year, the current year inclusive, we'd be looking at right up until the time that the RMDs start to hit.
Got it. So that does lead to additional question/discussion, because we do need 5 years worth of income from this portfolio now, right?
Mm-hmm.
If he's delaying Social Security.
Mm-hmm.
And for those of you listening, when I say an aggressive portfolio, and I'm just going to the overall portfolio right now, not necessarily by each account. And even with those upgrades, by the way, Eric, to the house, I'm sure we've both seen this before. I've seen clients do renovations that cost so little they can do it out of cash flow, and then literally clients do renovations that are in the hundreds of thousands to the million neighborhood.
Mm-hmm.
So I just wanted to make sure there's enough cash for there. But the overall portfolio is 83% in stocks and 14% in cash, 2% in bonds. I'm rounding. My rounding might be off a little bit, but you get the general point. Of those stocks, we've got almost half of them in tech. So this is not a portfolio built to create income in retirement. So to me, if there are income needs over the next 5 years, you've got to take at least a portion of the portfolio to address that.
That's a good point.
And
that's a really good
we
point.
can go through, thank you, and we can go through by account as well, which account will the money come from, and so on, and how to adjust. But Eric, you had said something earlier that was very key: being forced to sell in a down market. You never want to be a forced seller, right? So I think we've got to address that part up front. So, and we'll go a little bit deeper into the portfolio in a moment. But when I say address it up front, to me that means, where will the income come from? Which accounts will the income come from over the next 5 years? And then how will you generate that income stream? Are you relying on dividends? Are you relying on bond yields? Because I just want to avoid any risk of being a forced seller.
Yeah. And since we're on the topic of risk, one thing that really stood out to me when we ran the analysis and looked at the historical performance of the portfolio, which is something always good to make note of, is what was one of the biggest drops that the portfolio experienced. And this was in a 3-month time period between January 2020 to March 2020. I'm just going to round up. The portfolio had around a 20% decline on 2 million, which is around $400,000. So that's also something that you should just be aware of and make note of. Yes, we're looking at historical data as well, but is that something that, if you experience again, would you be comfortable with, especially if you're withdrawing from the portfolio that big of a decline? Obviously, we can't predict what's going to happen in the future, but that's just sort of a stress test that you can run on the portfolio as well, just to see if that's something that you can accept. Because as you're more aggressive, if you don't have a lot of diversification, especially outside of technology, this is something that can really make a major impact.
Yeah, and Adrian, that was my first question on risk. I think you bring up a very good point here. When we discuss risk, we always want to discuss the downside, and I definitely want to look at and have a discussion on, as I went back earlier, to where the income comes from. But the other thing with risk is it does change, right? So that's where my question for Mr. Davis is: is the risk of this portfolio reflective of who you were to build your wealth, or is this a reflection of who you are as a person in general, and will you still be this aggressive going forward?
Mm-hmm.
So do you want to stay at this level of an aggressive portfolio? So yeah, I like your point on that drawdown, because if you're facing a 20% drawdown in just a 3-month time period, well, you still need income. You're starting next month, and that's where we've got to get into the amounts of income and how to address it. But I'll continue on to the overall portfolio and just some of the thoughts here. My first thought with the overall portfolio is that there are a lot of holdings. Like, there are 98 holdings in the portfolio, right? So to me, I look at that and I think, um, is this a closet index portfolio, which means you've just got a lot of stuff and essentially you own the index because you own so much stuff? It's not based on performance, right? So I can say it's not that. However, what you've got going on in the portfolio is you've got these few individual tech stocks that are held that are masking a lot of these closet indexing / underperforming holdings.
Mm-hmm.
So to me, the very first thing to address is you got a $2 million portfolio. You've got 3,000 in this ETF, which means you've got like $150, $300 in the holdings within like an ETF, right? And that's just one of the lower percentage holdings. So what's the point? It's not going to move the needle on the portfolio. It's just going to cause you more work with something else to track. So those are the kind of when I say there are a lot of holdings, those are the questions I'd want to address when I say there are a lot of holdings. The questions being, how do they fit in the portfolio, and is there really place for this holding in the portfolio? Do you want to track and manage this portfolio that's just this part of the portfolio that's just so small? So I'd really address a lot of the holdings that I see as being more costly from a time perspective to manage than they will have a benefit to the portfolio.
And it's so concentrated in large growth. There's really not much diversification outside, where if you look at a multi-cap approach, there's not a lot of mid-cap stocks or small cap. There's not too much value stocks in this portfolio as well, which is a greater opportunity to diversify as well. And when we ran the analysis too, there was little to no bond exposure as well, or fixed income, which is another opportunity to just diversify more.
Yeah, and if you look at this portfolio from the perspective of the past, that makes sense because yields weren't great in bonds. So I get it. And while working and growing the portfolio, so I definitely understand that. But going back to what I said earlier, is that who you were, and will you no longer be that person in January when you retire, or is that who you'll always be? Right? Like, I've got clients that don't touch any of their assets. They've got minimum distributions that just go to charity, and then the investment portfolio is based on risk tolerance and comfort level and so on. I've got other clients that need certain amounts of return to accomplish their retirement goal, right? So it's just figuring out who he is as an individual, right? As an investor.
So let me just comment on a couple of those things. I think it's worth noting that 3 positions represent a very large share of the overall portfolio. When we say overall portfolio, we're talking about all the subcomponents being IRAs, inherited IRAs, Roth IRAs, 401ks and the Roth components of 401ks and taxable accounts, and on and on. So the 3 positions are Apple at 16% of the overall portfolio. So just speaking about that in real dollar numbers, that's over $300,000 of Apple. Then you have Broadcom at 6%. So that's again on the $2 million portfolio. Broadcom, that's somewhere in the neighborhood of 120,000. And then you have Microsoft, which is in excess of 4%. So there you're talking about, in this case, almost $90,000. If you were to take those positions out, just set those aside and treat those as a separate, I'm not saying, I don't mean this in a pejorative way, but just as, uh, hobby stocks, maybe, as opposed to allocation oriented positions, then what you'd see is the small caps are collectively about whether expressed directly or in the index funds, meaning in this case ETFs. In this case, they're 10% of the portfolio, which is a very close match with what the actual breakdown of the U.S. stock market is. About 10% of the market capitalization is in small caps, and most of that is concentrated in the small cap blend category. If you look at the mid caps as a whole, right now in this portfolio, it's 16%. But if you take out that 25% or so of those positions that are represented by again those three stocks, then what you'd say is okay, well, now the mid caps are really more like about 20% of the overall portfolio and concentrated in mid cap blend, which is actually fairly representative of the overall breakdown of the U.S. Stock market's market capitalization and so forth. So on that basis, I would say if you step back, extract those three, and then ask the question, is this well diversified? I would say it's probably a little tech heavy still. It is still a little tech heavy, but it isn't quite as egregious when you think about those three. And so then I would think in terms of just how do you deal with those three stocks? I think one way is to say maybe you use some hedges on those stocks. I'm not sure, just because they do. Their movement in the portfolio as a whole really does dictate the direction of the portfolio as a whole, largely because of the significance of their weight.
Can you expand
Well,
that
and
more, Eric? When you say hedges, for some of our listeners that maybe want you to elaborate on that more?
Yeah, I mean, I would think depending on your outlook, you might want to use some options contracts on those three positions. Again, those are Apple and Broadcom and Microsoft. Or you might just say, no, I don't need to use hedges on those because I'm persuaded enough that they, in the long run, are going to be extremely successful companies, and I'm just willing to wait through the volatility. I don't think there's a fundamental risk to their business models at this stage. Or, I'm not taking a position on that, by the way. I'm just saying, depending on what an investor's outlook was on that, it could shape whether or not they think it makes sense to use some sort of hedges of some kind.
Yeah, and I did have that on my list. I want to come back to that in a second, just to go to what you said. When you pull those holdings out, you had said you've got pretty much the U.S. stock market as a whole. I
Much
just
closer.
wanted to, I just wanted to bring that up because that's what I was saying earlier about, are you a closet index, right? If you side pocket those stocks, do you just have a bunch of holdings that gives you what the index does? Now, in certain accounts, it was really evident. The rollover IRA, the beneficiary IRA, you've got those portfolios. If you look at the overall performance, it looks like it's outperforming. Well, what's happening is you've got some of these stocks masking the underperformance of a lot of other holdings in there. So when I look at the portfolio, if you go the route, Eric, you said, of side pocketing these and taking it out, I'd have to look at the data just because I looked at the PDF. I didn't get to manipulate and adjust it. But is the portfolio then an underperformer? And I think it would be, from what I saw with the individual accounts.
Well, so first of all, I just want to clarify. I think that the client takes the position that they're not going to be an indefinite buy and holder. So they will look to see, based on what their outlook is about certain sectors or about certain asset classes, they will rotate. This client will rotate in. And by the way, I noticed that you called him Mr. Davis. You didn't use the fantastic pseudonym that I developed for his first name, Bertrand. I mean, don't you love Bertrand? Isn't that a great first name?
I had to Google search it because I never heard it before.
Oh, is that right? Oh man, I thought I should give myself a little gold star for just coming up with that. But anyway, Bertrand Davis, in this case, as it may be that the positions that you're seeing in that portfolio appear to, they create the tools that we use to assess the portfolio don't tell us how long a position has been held, and so we're making statements about these positions as if they'd been held for a long, long time. But I would say again, if he had held some of these positions for a while, I mean, offsetting this. And by the way, I'm not trying to kiss up to this client, because this is just, I think the client wants an honest assessment of the outlook. But I would say that if you look at some of the other top 15 holdings, you see some things like agribusiness. So Archer Daniels Midland is in the portfolio. You see a commitment to high dividend, an ETF that's is focused on high dividend stocks. You see a focus on some consumer staples, which is really sort of the anti-technology play. And so on that basis, I would say you said, Roshan, maybe he should just simplify everything. And aside from those three stocks, just do an all cap index fund, and he'll cover the same ground. I don't know about that, but maybe so.
And Erik, and I'm not suggesting that he should do that. I'm suggesting that he accidentally got there, not on purpose.
Okay,
right?
okay.
So then my question is, do you want to be there, or are you there by accident? Right? Is it intentional or not? And if you got there, if you want to be there, then maybe indexing for that part of the portfolio makes sense. But if you got there by accident, then I'd say you've got to address your methodology or how you made the selection. Another great point you made was we just see what they have, not when they bought. There are definitely some holdings in there that are significant underperformers based on the data that we have that I wouldn't sell because it looks like it has a good future outlook. If these were recent additions to the portfolio, I'd be applauding him instead of saying, why do you own this dog? So to speak, right?
Yes, for getting in on it while it's beaten down and awaiting the recovery. I looked at the valuations of the portfolio as a whole, and this is, again, at the aggregate portfolio level, the tool that we use to assess it has the capacity to develop a synthetic benchmark that simplifies things. So if it sees 85% of the portfolio in U.S. stocks, it just says, okay, we'll just use as a proxy for that 85% in our benchmark, we'll just use the S&P 500. If we see, X number of whatever it was in cash, then we'll use cash, of course. And if we see bonds, we'll use the Bloomberg Aggregate Bond Index. So on that basis, the portfolio can be largely compared to the S&P 500 because, as you pointed out, Roshan, it's 85%-ish U.S. stock. So on that level, when you look at the portfolio as a whole, on the valuation measures, it's close to, but slightly under the valuations of the broad market. I think that's impressive in that Apple and Microsoft and Broadcom are by no means priced on a valuations measure in ways that are similar to the broad index. So again, if you pull those out, then you'd say, well, impressively, the rest of the portfolio actually looks like it does have very more attractive valuations than the broad index does. Another measure, though, I think cuts the opposite way, and that is it doesn't distinguish itself in very many ways on the profitability and quality measures, although it does on the return on equity. And that's commonly the case with high growth tech stocks, that they have exceptional return on equity. But if you pull those out, then the rest of the portfolio doesn't look like it is as well positioned from an overall profitability measure or return on an investment or other sorts of measures that we would use. So I think it's a mixed bag of, probably aside from those three hobby stocks, I'll just call them, attractive valuations, but also not necessarily spectacularly attractive quality.
And as you said, that could be where it is now. But maybe Bertrand sees an opportunity there in some of these holdings or some of these sectors now, which is definitely different than if he held them for 10 years. And as I said, you've got underperformers. One thing you mentioned earlier that I want to go back to regarding those three stocks in particular that he has big positions on is the hedges. So what I was looking at on there is there a sales price that he would feel comfortable selling? If so, and can you write covered calls to generate income, or can you write covered calls to generate income that you can then use to purchase puts to give you downside protection? So you had mentioned the options. I just wanted to go back to that a little bit and say, so the way a covered call works, if you've got stock ABC and it's trading at $100, well, you can say, I'll sell it if it's trading at 110 next month, and you can then get, let's just say you get 50 cents per share. You get to keep that 50 cents per share. If it's trading at 109 at the end of next month, you just keep the 50 cents and you're fine. If it goes up to 115, well, your upside's capped at 110 because you've already agreed to sell it at 110. That's how the covered call works. We've discussed this before. We've got an episode that's dedicated to options and option strategy that I'd say check out if you want further information on that. But to me, when I look at these kind of stock positions, if there is a sales price you'd be willing to sell, I'd say, hey, why not make a little bit of money on the income of the portfolio along the way? And by the way, these contracts are done on 100 share increments, so it doesn't have to be the same price. You can say for this 100 shares, I want to do it at 110 on my example, and the next 100 shares at 115. So on and so forth. So I just view that as, is there an opportunity there to either generate income, particularly when you think about retiring next year, or use that income to protect the downside of the portfolio? The key in this, particularly in a down market like this, is I'm always hesitant to write an option at a price you're not willing to sell, because you don't want it to go through. If you don't want it to go through at that price, uh, said differently, I wouldn't view this as an income opportunity only, right? I'd view this as, yes, I'm generating income, but I have to be willing to sell it at this price, or I'll just be, you won't make enough, right? In that example of the stock trading at 100, you're selling it at 110 next month, and you're getting 50 cents a share. Well, if it's at 115, to get that 50 cents a share, you missed $5 a share on the upside. So I would say make sure that's a good price for you.
Well, just in terms of now I'm moving from an investment commentary to a planning commentary, which is probably my happy space most of the time, is to think about what can we do to minimize the tax consequences of these embedded capital gains, particularly in the Apple position. And there's two that this client and I have discussed. So number one is to fund a donor advised fund with some of the appreciated positions, the most highly appreciated positions. That doesn't mean that you have to have less of that stock, by the way, our dear listener. If you have a stock that you really, really love and you're thinking, why would I want to give it away? And in terms of as a source of charitable giving funding, you can repurchase that same stock instead of putting cash into a donor advised fund, or instead of making cash donations. You can just make these appreciated stock donations and then repurchase the stock. You might say, well, why would I do that? Well, because you reset your basis at the new higher level. And as a result, in the future, you won't have the same degree of embedded capital gain. So anyway, that's one intention for this client, is to use the most highly appreciated positions to fund some donor advised fund giving. The other part of this strategy, though, is during those 5 years, if you can, that is to say, before Social Security kicks in, and even more so before the required minimum distributions kick in at age 72, if it's possible to indeed keep the marginal income tax bracket at the federal level, be somewhere in the current 12% marginal income tax bracket, maybe even closer to 10, or even closer to 0. That means that you can sell a highly appreciated position, realize those capital gains that were formerly unrealized, and assuming they're long term, pay 0% tax on those long term capital gains. That's fantastic. So you essentially made that purchase, you got all that growth, and then you pay zero tax, at least at the federal level, on that gain. So this this use of manufacturing an artificially a period of artificially low marginal income tax rates is not only useful for Roth conversions, but it can be useful as an alternative to that to realize some capital gains at the 0% tax rate.
Great move.
So,
That's a really
thanks.
good move. Both of
Yeah.
them. Yeah. Both of them are really good moves. Let me see if I've got anything else that really stands out on the list of things to cover, and I'll just review actually everything because I think I've covered the high points. But first, I'd want to clear up a risk tolerance going forward. Make sure cash is sufficient, which you said it is. Have an income plan from age 65 to 70, so I know what parts of the portfolio I need to dedicate to that. And then next, within the portfolio, I'd want to make a decision on those stocks, right? On the stocks, how do they fit in the portfolio? Or should they be quote unquote side pocketed or called hobby stocks and just managed separately? Then addressing the rest of the portfolio, looking at is that really historical underperformance, or are these strategic moves in those individual holdings that you've got in there? And if they're strategic moves, I just want to discuss it, just sort of flesh out the idea a little bit further. If there are some underperforming holdings that have been put in the portfolio, I'd want to address those. How do you adjust and manage the portfolio? Now, granted, I understand part of the reason there are so many holdings is because they're across multiple accounts. But is that like, do you really need that $3,000 position in an obscure ETF versus putting it into something else? Gentlemen, do you have anything you'd add on the overall portfolio review?
Maybe just I would tip my hat to the client, because this client has clearly devoted a lot of energy to understanding and looking at and evaluating various issues, whether they're stocks or ETFs, and not a lot of people have that much energy or self confidence to do that. So on that level, at least, I would say, it's a cool thing to see a client who's put in the time over the years to develop that level of know-how and confidence. That doesn't mean, and I'm not saying this self-servingly, but it doesn't mean that necessarily that's something that the client wants to, any client wants to continue doing. I might be really, really good at doing my own taxes. But that doesn't mean that I should keep doing that. I mean, there might be just more enjoyable ways to spend my time.
Yeah, and the last thing I'll add is I'll definitely give a thumbs up to the portfolio on a risk adjusted basis. It's a very aggressive portfolio, but as far as the numbers and the data shows, they're getting paid as far as the return on the risks that they're taking. So I always give that a thumbs up as well. If it was the opposite, that'd be very concerning if they were taking on a lot of risk, but historically they haven't been performing well. We'd be looking at adjustments there, but that's not the case here.
Yeah, so Mr. Bertrand Davis, I hope you found this helpful, and I hope it gave you some things to look at and discuss. I actually think we'd have some fun conversations just with the portfolio you have and the way you manage it. I've got a few people will have these nerdy finance discussions. I think he'd be a welcome addition to that group. So we hope you found this helpful. For everyone listening, we hope you found this helpful as well. Just an angle to think about your portfolio. You may be in a situation where you've got some really good winners out there that are masking some others. You may be looking at strategic moves, and also hope this will let you know that we're happy to review your portfolio like this. If you'd like, please reach out to us. Our information can be found in the show notes. Thank you for listening. We'll be back with another great episode next week. This has been the Retirement Lifestyle Show.